Are you wondering what's ahead for our housing markets? Well, in this week's Property Insider Chat, Dr. Andrew Wilson and I discuss a number of the leading indicators that give us a clue to what's ahead. We talk about housing finance approvals, building commencements, because not all approvals start off. We have a chat about inflation, interest rates, and of course the auction results. If you want to keep up to date with what's happening in our property markets, please subscribe to this YouTube channel and click the little bell icon so we can notify you each time a new show comes out. Australia's housing markets continue to defy the expectations of many of the commentators, despite the 12 interest rate rises from the Reserve Bank, which have seen official rates go up around 4% over the last year. House prices stopped falling earlier this year and have now been on the rise for 6 months. Strong migration, lower listing volumes, fewer properties for sale, and a relatively strong economy with virtually full employment has helped underpin our housing markets. While many commentators have been concerned about that fixed rate cliff, official data indicates the majority of mortgage debt's on variable terms. Many people have already been overpaying their mortgages, others have refinanced. So it looks like inflation's now peaked, and it's likely that interest rates may have. There could be one more rise, but in due course, consumer confidence will return and the markets will continue their upward trajectory. But our markets are fragmented. So those interested in property are wondering, well, what's ahead? Well, in today's Property Insider Chat with Australia's leading independent housing economist, Dr. Andrew Wilson, Chief Economist of My Housing Market, I'd like to look at some of the forward indicators that'll give us a clue of what's in store. Things like housing finance approvals, housing approvals, construction cost, inflation, and of course our auction markets. There's lots to discuss. So hello, Andrew.
Yeah, good day, Michael. And I think it's interesting, your comment regarding consumer confidence. I think our consumer confidence on the numbers is pretty high, and it's certainly recovered from the depths of COVID and higher interest rates last year. I think we're still full steam ahead in terms of what we're doing, what we're spending on. And I think it's a, what can we say, bubbly economy. It doesn't get much better than this, Michael. And yes, we know interest rates are higher and they have increased and put stress. But with 3 pauses over the last 4 months, Michael, as you said, that's a pretty fair sign and nice relief for mortgage holders. And understanding that official interest rates now are still the best part of 1% below where they were when they peaked in 2012. And this week we get important data out. We get the wage price data out. The wage index data will be released for the June quarter. And will we see a 4% increase? I think we'll get pretty close to that, given how strong the economy is.
Clearly, some people are having a difficult time with higher mortgage costs, higher rents, increased cost of living. But as you say, everyone who wants a job's got a job, and they are still spending, aren't they? Let's look at some of the housing market factors, though. Building approvals are one of the indicators we look at to give us an indication of what's coming up in the future in housing markets, Andrew.
Yeah, we know, Michael, that we're clearly one of the drivers of higher prices and higher rents is a chronic undersupply of new or properties generally, but that reflects low building levels really since 2015-16 when the cycle peaked. In fact, we're tracking around about or over 30% fewer on trend homes that we're building now compared to the previous peak back in 2015-16. Also, in spite of that burst that we had through the home builder policy of the previous government, which has unfortunately got us into a bit of hot water in terms of constraining even more the outlook for new homes because of high building costs, which have been a direct result of that policy. And even though I guess intentions were good, it's actually been one of these issues where beware the law of unintended consequences, because it's going to really create another barrier to new home building. But we did get the latest data, as you said, for home building approval out for June. Building approvals were down overall by 7.7%. Units were down 21%, houses down marginally by 1.3%. And no surprise that units fell over the month, Michael, as we had a very strong result the previous month for units. And that, of course, was a spike due to a very large number of approvals in Sydney for a big apartment development. And that's what we see from month to month with the apartment data, is it can be quite volatile because you can get a big number coming through. And that's what occurred in May. Then we, of course, got back to more of a normal environment. In New South Wales, approvals were down by 44.9% following that big rise over May. So really nothing, which was good to see the rise, let's be clear, but we need to see a lot more of those rises to start to rebalance what is clearly a chronic shortage of housing in this country. So when we look at the numbers, the trend is still downwards. It's evened out a little bit given that surge we had over May due to those Sydney approvals for apartments. Over the year to date, we're still well down on the same period last year, Michael. Houses down 14.6%, units down 17.3%, and overall dwelling approvals over the first 6 months of this year are down by 15.6%, and similar results there when we look at the year-on-year results, the year to June, so that's the financial year, I guess. This financial year versus the previous financial year, we're still down overall by 12.3% in terms of home building approvals, Michael. Again, that is coming off the back of a very strong rise in 2021 as a result of home builder. But as we alluded to, Michael, the issue with home builder has been house building costs going through the roof. And even though we've certainly seen an improvement in house building costs, My Housing Market runs a monthly house building cost index, and the rate of growth has certainly continues to ease over June, but it's still quite high. We can see the index is nearly 45% higher compared to where it was in 2021 prior to the burst from home builder. And the rate of growth, even though it is moderating, is still at 11.7%, Michael. Now, that's the annual rate of growth of the quarterly index, which, of course, is what's used for the inflation model for house building costs, which are an important factor in the basket of goods. But still rising, Michael, by 11.7% over the year. Now, that's half of what it was at its peak a year ago, when building costs were horrifically rising by 23.3% annually. But it's still, obviously, if builders are faced with 10% plus increases in their costs, it does put a lot of pressure on the financial, the balance sheets of builders, and that acts to constrain getting jobs out of the ground.
Well, not only have building costs gone up, but the cost of raw land has gone up, which means that all those new dwellings that are going to eventually have to be built are going to be a lot more expensive, Andrew.
I mean, we know the story behind lower building approvals has been planning restrictions, red tape, green tape, which is endemic to the construction industry, and it has created this undersupply environment, which is pushing up rents and prices, of course. And we have a measure that we use, Michael, which I've put together just to show that even if we are getting more building approvals through, they're not necessarily going to be translating into commencements out of the ground jobs, which of course is what we need, or out of the ground houses and units, which of course is what we need to cater for the surge in demand currently. And when we compare on a chart building approvals with building commencements, and we lag those approvals by a quarter, which is about what it usually takes for that approval on average to become a commencement, we can see that over the longer period, it's been a reasonably accurate or an accurate reflection in terms of the lags between approvals and commencements. But if we look closely, Michael, at the last few quarters, we can actually see that the commencements are now lower than the approvals. So that's giving us that first sign that we won't be getting as many commencements in real time or in the same time as approvals coming through. So that again just means that we're going to continue to undersupply our housing market as a result, more now, or certainly contributed to by these very high building costs constraining builders.
There's obviously not a simple answer to this. There are many factors involved. Now, I know later this week, the government's going to be sitting down, having a think tank about what's going to happen with our housing supply. That'll be an interesting discussion for us next week. But one of the other factors we look at that gives us an indication of what's ahead are home loans. finance approvals. They're often a leading indicator of what's ahead, Andrew.
We had a fall in home loans, according to the ABS. Total loans were down by 1.1% over the month. These, of course, seasonally adjusted. It was all about owner-occupier lending, down by 3.5%. Investors were up, however, by 2.6%. First home buyers up by just 0.2%. I am questioning the data to some degree. We have discussed, Michael, the issues with seasonal adjustment modelling from the ABS as a result of the COVID lockdown period, which is really put that on its head to some degree. It'll take some time for the seasonal adjustment models to, I guess, reflect what we would expect in terms of what are typically weaker months or stronger months over the year. So I would take this with a grain of salt, this data. We do know housing markets are rising strongly at the moment in terms of prices, in terms of volumes. So it's a little anti-intuitive to see home loans down reasonably sharply there for owner-occupiers by 3.5%. So as I said, let's just take this with a grain of salt. And when we look at the series, Michael, it certainly has risen this year as housing markets have risen, and we would expect that. But it's been a little bit of a volatile ride from month to month. And I do think perhaps that is to do with the seasonal adjustment modelling, which is not picking up as yet the normality of the post-COVID lockdown. Investor lending has certainly been the best performer this year through those volatility issues. So investors look to still be quite interested in the housing market at the moment, Michael. We shouldn't really be surprised, I guess, with clear capital growth occurring and also strong rental growth as well, which must be an incentive for investors who nonetheless have to pay higher interest rates, and also a number of new charges that are coming through that are being directed quite, again, ponderously at investors. I would have thought we need more investors, not fewer investors, but I think governments are putting themselves into a corner now, Michael, in terms of their responses to what's happening in our rental markets and the undersupply issue, as you said. I'm not sure a gab fest, another gab, will cure the issue, but I guess they like to be seen to be doing something, even if nothing happens as a result.
That's right. Now, when we look at why there aren't as many finance approvals yet transactions are occurring, one of the interesting facts that have come out of PEXA, which is the housing conveyancing platform where housing transactions, conveyances now occur online, is that over the last couple of months, around 1/3, 1 in 3 transactions, there's no finance involved at all. I guess this is in general, Andrew, the more established homeowners who are upsizing or right-sizing, and they sell their home and they don't need a bank involved. So clearly a lot of transactions are still occurring, and probably at the more expensive end of the market, without a loan at all.
Moves back into the narratives that we're seeing in terms of being challenged, particularly about that lending cliff. We're heading into the spring selling season, Michael. Plenty of effervescence, plenty of confidence in the marketplace before the spring selling season occurs. So again, it's just another one of these ridiculous media furphies that have been put up as a scare campaign to create clicks. Again, proven to be just ridiculous. We've sort of promoted that. It would be the likely outcome. And once again, that's what's happened. And as you said, a lot of the transactions that are occurring without a mortgage.
It wouldn't be a Property Insiders chat without at least having a quick chat about inflation. The August statement of monetary policy provided an update to the Reserve Bank's forecasts. The last statement was 3 months ago, and it actually moved the horizon out of where it's now looking for its forecast to December 2025. The Reserve Bank's inflation forecast still doesn't envisage either core or headline inflation reaching the middle of their target range by the end of 2025, which I guess is 2.5 years. They think it's still only going to be about 2.8%. Now, there's a lot of external factors affecting us, not just interest rates. A lot of it seems to be, you can often mention the price of oil, and you just have to go to the petrol station and see what it was last week. Interestingly, it dropped this weekend. I have no idea why at the petrol station, not in the big markets.
Well, we have seen the price of petrol, of course, Michael, heading back up towards $2 a litre. The price of oil internationally is now on the rise again. Of course, one of the key factors that has brought headline inflation down has been a steep fall in the price of oil, the international price of oil. At its peak last year, we were over $120 US a barrel. We're now up at $80 US a barrel, but we were below $70 US a barrel a month or so ago, Michael, and we've certainly seen an uptick in the price of oil. Now, it's still tracking lower than where it was a year ago, and that's why we're seeing a lower inflation rate, Michael. But if the price of oil continues to rise, we're going to lose that capacity to have lower inflation because of a lower oil price. And so we need to be very wary of that, because it's not just the comparison with the price of oil on a year-on-year basis. It's also the impact that higher fuel costs has generally on higher prices through particularly transport costs. And just when it looked like we were going to get some relief from high petrol prices, oil prices, we're now seeing a clear upswing in the trend. Now, these things are volatile. We don't know what the future is going to hold with oil. There are a number of factors that generate oil prices, but certainly we can now be concerned with it now rising above $80 a barrel. As I said, it is still lower than where it was a year ago, Michael. So it's still an improvement in terms of the inflation rate, but it's not too far away. And if it continues to rise, it'll start adding to headline inflation, Michael, because it is a significant factor, as well as those other factors, as I mentioned, that are influenced by higher fuel costs. So beware, Reserve Bank. Again, these are outside issues that will perhaps in the shorter term affect their forecast for inflation. So as I said, the reduction in headline inflation really has been a story about lower oil prices and the improvement in supply chain issues that were created through COVID. It had nothing to do with interest rates, Michael. We'd still be here, I believe. We probably could even have a lower inflation rate if we hadn't have increased interest rates, because inflation now is all about the strong economy and fueling good services prices.
I just wanted to remind you that this is not specific investment advice, because we don't know your personal circumstances, but we're more than happy to have a chat to help you take advantage of this new property cycle. If you think about it, the opportunity like this to get set at the beginning of a new property cycle doesn't happen very often. So why not have an obligation-free chat with my team at Metropole to discuss your goals and to discuss your options? We're much more than just another buyer's agent. We help you safely create intergenerational wealth through property. We're big enough to tip the scales in your favour, but still small enough to care. And as we don't sell any properties, our advice is independent and unbiased. Now remember, property investment's a process, it's not an event, so you can't just go out and buy any property and hope to be successful. In fact, now more than ever, getting the right advice is critical. So if you're looking to invest in property or buy a new home, go to metropole.com.au and have a chat with our multi-award winning team. It's a great feeling having the team at Metropole on your side, levelling the playing field. If each week you take a careful look at the auction markets, you report them in your LinkedIn profile, and I'll leave a link for that in the show notes, where every Sunday morning you give a very detailed report and we publish that on Property Update. Over winter time, the auction markets generally become a bit quieter. We've actually got through winter with very strong results, Andrew.
I think it's been a very positive winter season, Michael. We're only 2 weeks away from the spring selling season. We're already seeing positive signs of a revival in the spring market to come. We track new listings at My Housing Market. We've seen a big rise in new listings over the past week or so, which of course is a precursor, those wanting to bring their houses into the marketplace, particularly for auction in September. So they're now adding to new listings coming through, which are picking up as they typically do this time of the year. But it's been, a very positive August and July for the auction markets, Michael. We typically see, as you said, because there's a change in the mix of properties coming through during winter, we typically see a much higher proportion of lower priced properties. We see fewer properties generally for sale. Those numbers have held up quite well. I think it reflects the revival mode that has continued in housing markets, Michael, even with what is typically the weakest part of the year. And there was no surprises in terms of that position with the results on the weekend, Michael, which, as I said, are going to just act to support the spring selling season, because we've already got a buoyant market. Listing numbers were again quite impressive. For this time of the year, Michael, Sydney numbers were up. Another very strong clearance rate in Sydney, 77%, so around about the same as the weekend before. Auction numbers are well ahead of where they were a year ago, Michael. Of course, we were suffering from that fear factor from higher interest rates a year ago, so numbers were lower. But a very good result in Sydney. Similarly, in Melbourne, they had an uptick in auction numbers. Clearance rates around about the same as where they were the weekend before, Michael, 73%, which again certainly is a number that's in favour of most sellers and would be encouraging sellers into the market with those obvious strong competition for property. Brisbane, after its break the weekend before, numbers were up again and the clearance rate was up. Another robust result for the Brisbane market. Adelaide, the same results this weekend as last weekend. I sort of checked that, but it was, yes, one of those remarkable statistics.
I wondered about that, yes.
Yes. But no, I think it was the same, but a few reported auctions coming through. But nonetheless, we know that Adelaide market is very strong. That auction market in Adelaide is very strong and typically produces those 80% plus clearance rates. And Canberra, another solid result for Canberra. It's really been the big improver this year, the Canberra market, obviously earlier in the year being certainly, struggling to produce 50% clearance rates. Again, as we always suggest, the Sydney market has helped pull along the Canberra market as it does, and that's now producing some reasonable results there for most sellers. Clearance rates so far over August, Michael, compared to previous months, Sydney's actually now tracking higher than July over August. And, again, that's just emphasising the underlying strength of the Sydney market, which didn't move below 70% over winter to date. Melbourne, reasonably the same over August so far compared to July, again, well above 70%. Brisbane down a little bit, but that does reflect that weak result last weekend as a result of the holiday period in Brisbane. And Adelaide continues to scoot along above 80%, no surprises there. And Canberra has actually pulled above its July and June results so far over August. So, Michael, no bad news there for sellers in the market. Lots of work to do for buyers to secure a property because there is a lot of competition for property out there. And we are just 2 weekends away from the spring selling season.
Well, just confirming what you said a moment ago, on the weekend, I went to an auction and bid for my nephew and got him a property, but there were a lot of other buyers there too, as you said. They missed out. They were upset. And then now know that next weekend they're going to have to go again and pay $500, $1,000, $2,000 more. That's what's happening in the market. There's quite some depth, Andrew.
Yes, there is, Michael. And we will start to see what we always see in spring is the strength of the mid to higher price markets. They will come roaring back through spring. September, October, and that's a market that I believe has plenty of upside, particularly the higher priced properties, which when we look over the longer period, certainly underperform compared to mid to lower priced properties. So I think that's another factor that, in a sense, a little bit of the missing link that will be found. Buyers will be looking to upgrade into higher priced properties, which will come into the market, I believe, through the spring selling season, as usually happens, because that is the strongest time of the year for that particular part of the market.
We'll be back next week and actually every week this time to report on what's happening in the market. Thanks for your time, Andrew.